Good morning and good afternoon, everyone, and thank you for joining us today. A very warm welcome to Acuity Knowledge Partners webinar, Is Your Lending Organization Credit Fit for 2025 Landscape? Today, the focus of our discussion is about understanding how the lending business will evolve through to 2025 and how banks are planning to build a resilient yet profitable lending business for future. I'm sure all of us are eager to hear how banks still continue to look at their transformation and digitization initiatives despite several challenges of the ever-evolving global pandemic, rising interest rates, changing consumer sentiments, and not to forget the recent geopolitical developments. Before we get on to an engaging discussion, some housekeeping items. Today's session is for 60 minutes, which we will certainly aim to make very interactive. 50 minutes would be a virtual roundtable discussion with our experienced panelists and industry veterans, and 10 minutes for the Q&A. Request the attendees to submit their questions in the Q&A box at the bottom of the screen. We will address them during the Q&A session, and if we run out of time, we will definitely circle back to you with the responses after the webinar. Today, we have a number of participants from across around 80 companies and over 16 countries. And these are some of the logos of the companies from where we have representation today. So thank you so much for joining us. And to introduce myself, I'm Raju Sood, and I'm Senior Director and Global Head of Lending Services at Acuity Knowledge Partners, and I will be the moderator for today's discussion. For those who don't know us, Acuity Knowledge Partners is a leading provider of offshore research and analytics solutions to the financial services sector, servicing over 400 financial institutions globally with a team of more than 4,000 financial services domain specialists. We service these leading financial institutions across different areas like investment banking, investment research, marketing, lending services, compliance, risk management, and data analytics. Particularly if we talk of lending services, we work as strategic partner for banks, and we have over 20 years of experience in helping them with their transformation initiatives. We support across the lending value chain, starting from credit admin and portfolio monitoring activities to underwriting origination support across different asset classes and portfolios. At the heart of what we bring to the table are our deep domain capabilities, a strong innovation, bespoke technology solutions, and most importantly, the knowledge of our lending systems and processes. We have helped our clients achieve sustainable operational efficiencies, speed to market cost savings, and most importantly, improve credit risk governance. So with this introduction, I would now like to request our esteemed panelists to introduce themselves. So over to you, David.
Oh, thank you. Thanks, Rajul. I'm not sure it's esteemed is the right word, but let's go with that. Yes, and you're right. It's an interesting time to be in banking. So I'm Dave Martens. I work for Natixis. It's owned by a French company, French bank, obviously French company, BCPE. Has about 900 billion in assets, and I think it's the fourth largest bank in France. For those of you who may not be familiar with the name, I run portfolio management for the Americas. And that actually has a different meaning to different people. When I say portfolio management, we have about 20 billion in loans here in New York or in the United States and Latin America. And it's about 350, 360 accounts. And my team does all the credit work, credit monitoring, amendments, et cetera, for that. That's a little bit different than sometimes the big banks have a public side portfolio management, more involved in day-to-day trading and things like that. And that's not us. We actually do all the real credit work. My background is mostly with foreign banks. Was with Morgan Stanley for a short time and JP Morgan, or one of the predecessors to JP Morgan, for a short time, but most of my time has been spent with European banks. I spent a lot of time at ABN AMRO, which became RBS, and my roles in those places have been both first and second line, both origination, project finance, things like that, as well as I was chief risk officer for ABN AMRO and LATAM down in Brazil. And so I've sort of bopped back and forth between the first and second line, and I actually enjoy the portfolio management. We obviously work really closely with the second line, every day. And so I enjoy doing what we're doing now. So I'm going to now pass it over to Michael. Looking forward to talking more.
Good. And good morning, good afternoon, or evening, wherever you're located, and thank you for having me. I'm Michael Walker, and I'm in charge of the commercial bank at City National Bank. The commercial bank at City National Bank is in 19 different locations in California and the East Coast, in New York, Washington, D.C., and Boston. We are 100% owned by RBC, the Royal Bank of Canada, and we serve clients with revenues from $25 million up to $500 million in annual revenue. And I'm very much looking forward to today's conversation. So thanks for having me, and I'll turn it over to you, Bob.
Great, thanks, Michael. Good afternoon, everyone, and thanks for joining us today for our panel discussion. My name is Robert Zeller, and I am head of Banking Group Portfolio Management at KeyBank in Cleveland, Ohio. I've been with KeyBank for about 20 years and in banking for over 35 years. And I too have spent time on the line and in credit and portfolio management. So all aspects of lending. Banking Group Portfolio Management is the underwriting and portfolio management group that services a good portion of KeyBank's commercial loan portfolio. We handle loans from the very smallest that come in from our branch network to the very largest syndicated loans that are originated in our institutional bank. We have a team of over 300 people, and we work very closely with Acuity. There's about 100 Acuity partners that work with us to help us with our work every day. So with that, I will pass it over to Tom Crandall.
Thanks, Bob. Tom Crandall. I also am in Banking Group Portfolio Management. I have been with KeyBank and its predecessors almost 32 years now, and almost the entire time in portfolio management, primarily large corporate loans. Currently manage a portfolio of about 480 clients and about 25 billion in commitments. And I'll pass it back to you, Rajul.
Thank you so much, Tom, and thank you so much, everyone. We are very glad to have you here. Just very related to the discussion today, I would first like to share an interesting survey of senior decision makers at global and regional banks, and you can see some of the results on the screen. So monitoring credit quality of existing clients emerged as the #1 challenge for banks, with increasing new business and digitization, of course, as the close second. 90% of the respondents actually voted for managing credit risk efficiently as their top priority. And complying with regulatory requirements, need to improve internal digital infrastructure also remained highly relevant. As digitization is now at the heart of the business transformation strategies, a large number of banks are now open to new strategic partners as well. 96% of the respondents considered fragmented systems to be the main hurdle on the path of automation. And 82% of them agreed that the lack of standardization is also one of the major challenges. Last but not the least, digitization. The decision makers actually agree on the importance of reinventing the lending landscape with intelligent automation. 43% of them actively are looking for new opportunities to digitize, and 71% are focused on automating the monitoring function first. I hope all of you would resonate with this survey, and some of it will also be discussed on today's discussion maybe. So, when we talk of digitization, I'm assuming a lot of banks are now already on the path of digitization. So my first question would be for Robert Zeller from KeyBank. Robert, what are the key lessons from your digitization journey? And what are your key digitization related focus areas through 2025?
Sure, thank you, Rajul. So first, let me talk about a few lessons that we've sort of learned along the way. So everybody wants to digitize their organization and become more efficient. The cost of banking is rising fast, and we need to service our clients more effectively to remain competitive. And moving your organization towards a digitization can help you do that, but it's not always as easy as it seems. So here's a few things that you may want to watch out for. So whenever you embark on your digitization journey, you need to evaluate your processes, procedures, and policies along the way. Now, along the way, you're going to find some easy, quick wins that remove pain points in your process. And those are usually not a problem because everyone will recognize the value of fixing those things. However, when you start to change how people work or change their workflow, you're going to encounter resistance because generally people don't like change. And anytime that we've tried to streamline a process or use technology to gain efficiency in a procedure, we inevitably wind up talking about the exception process or the workarounds to the process, because at the end of the day, someone will say why the new process doesn't work for them. So don't let those become the rule. Next is make sure you get buy-in from all of your stakeholders. When you make a process more efficient in one area, you may have downstream impact that you weren't expecting. Get out in front of that by keeping stakeholders informed. There may be unintended consequences, and you may run into people who ultimately will stand in the way in progress because they weren't consulted up front. So you want to just make sure you get out in front of that. Implementing new technology is not always as originally sold, and it will take time to implement. There are always legacy systems that won't talk to each other the way they should or the way that they're supposed to. So be patient and work through those issues, and at the end, usually it's worth it. But don't let the technology people tell you what can and can't be done, because the reality of it is almost anything can be done. It's just a matter of time, resources, and money. So you need to find people who can challenge the techies. So at the end of the day, it's the line of business that winds up making the decisions and not the IT department. And then finally, what I'll say about lessons is, the IT or the tech departments really only have so much bandwidth and have limited resources. And not all of your projects are going to get funded, especially the nice to haves. Projects get stack ranked. And from my experience, the ones that save money or improve the client experience are the ones that get more attention. So make sure that you look at that, and then your projects will get more consideration. So quickly, I'll mention a couple of things that we're focusing on at KeyBank this year and really and beyond. So we have a number of projects that fall under the umbrella of simplifying the lending and portfolio management process. And the first one I'll mention is the continued rollout of nCino and the onboarding of new lending groups to our nCino platform. Now, nCino is a very complex underwriting platform. It has many benefits, but it takes great effort to implement. And we need to complete that process of onboarding the rest of BGPM onto nCino in the next couple of years. That's really important for us. From an automation standpoint, again, we're looking at a client portal to allow our clients to electronically submit financial statements and other documents to us. And we're hoping that will improve the client experience and efficiency, and actually allow us to track financial statements in a more automated way. Auto spreading of financial statements is another thing we're working on, but I got to be honest, I'm not convinced at this point that that's going to work the way we would like it to. Seems to work fine for public companies, but others not so much. So we're going to continue exploring that, and Acuity is actually helping us with that effort. The last thing I'll mention quickly is our red flag report. And banks gather a lot of data about their clients when you think about DDA activity or borrowing patterns or public data. And we're trying to use that data in a more effective way to monitor our client activity and to alert us to any behavior changes that may be an issue. So that's what we have going on. And with that, Rajul, I'll turn it back to you.
Well, Bob, let me just pile on just for a quick minute, because we too at National are in the very early stages of an nCino implementation, and in our organization, the commercial bank is sort of leading that charge. But it sounds like you're, a little further along than we are. But back to your earlier comments, what's interesting to me is, and I'd love to hear your view on it, is the change management aspect, because as you mentioned, change isn't easy, and you've got sometimes the business line has a different objective than, say, technology. How are you working through the sort of the change management aspects?
Yeah, it's organized focus groups. It's organized, it's building a team around it that's diverse, that has all the stakeholders involved. And because ultimately you think somebody thinks it's a good idea, and there are definitely going to be people who don't think it's such a good idea, and you need to join those up and to solve those issues up front. Because if you head too far down a path and you don't do that, it doesn't usually end well. So,
Right.
And you wind up doing a lot of rework. So.
Right.
Absolutely.
I'm gonna add one more thing to that too, Robert, because I completely agree. I'm gonna add one more phrase. You use the term workarounds, and I completely agree. When you're talking about an IT system, you have a design, you have a value that's supposed to give you, and somewhere along the implementation, you run into problems, and you start developing these workarounds. The European version of that, and it's the one I hate, is called out of scope. So somewhere along in an IT projection, they say, we really can't fix this problem, so we're going to take this problem out of scope, meaning we're not going to deal with that right now. And so inevitably, when that starts happening more and more, you get 70% of what you expected because they keep doing it. So that's the European version of workaround, is out of scope. And people need to be very careful when that starts getting used.
Yeah, absolutely. And if you do too much of that, your solution will not be nearly as effective as you think it will be or should be.
Yeah, and on auto spreading, actually, this topic is really close to my heart, so I can't stop myself adding. When it comes to corporate and commercial banks, the variability in the portfolio, the formats and adjustment is so high that it's really important to understand that the automation is going to be a slow process, and it will require bespoke and continuous training. And very rightly said, Bob and Michael, key is to manage organizational change. It is critical to prioritize. It is critical to secure buy-in, to clearly determine the art of possibility, and to have the right skill set and experience to implement change. And needless to say, change is important to stay competitive. So that probably takes me, sorry, Michael, you were saying something?
No.
Yeah, so that actually takes me to my second question to you, Michael. How much of an impact do you think disruptor banks have on your business, and what do you think is your strategy to become future ready?
Well, let me answer the second question first, because at City National, we're sort of on a path to becoming a more digitally enabled commercial bank, which means we have to have products and services to deliver to our clients in a way that they want to be delivered to. So that can mean physically in person, digitally through a website, or in a mobile environment. And for example, in the last 18 months, we've overhauled our treasury management platform and our mobile app, among other things. But, we're in the early stages of this, and I think it's fair to say that it's really, more than anything else, a never-ending journey, because products and markets keep evolving and individuals and company preferences continue to evolve. So from that perspective, I would tell you it's pretty difficult to assess the impact that the disruptors that you mentioned are having on our business. And they, in most cases, tend to be more product driven. And banks like City National, we're much more relationship driven, and we tend to, approach our clients holistically. But, we can't make the mistake that holistic means we don't have to be either technology, price, service, or solution competitive. I mean, we realize we just have to have the right value proposition and have the appropriate balance in all of those areas.
Thank you, Michael. I think, at least in the near term, the fintechs and the non-regulated players will likely focus towards the thin file customers. And I'm sure the traditional banks will benefit, as you said, on the ingrained relationships. And they will also explore opportunities to become more lean and agile, working under strict regulatory framework. So
right. Recall that, many of the disruptors that you refer to tend to be, fintech companies, which operate in a much different regulatory environment than most of us on this call do. And that also, to a certain extent, creates a not so level playing field. But, we continue to, march on and serve our clients as best we can, given the situation.
Absolutely. Absolutely, Michael. And that actually brings me to my next question, which I'll probably, take it to Tom. Tom, how do you think banks are rethinking their operating structures? And, how do you think, an agile structure would look like?
It's interesting. I think rethinking operating structures is nothing new for banks. I think for decades, banks have been doing it. I think we all recall maybe the 890s, the early aughts, where some of the larger banks went first and thought about outsourcing certain activities. And those of us in the industry heard that those maybe didn't turn out so well. And, they wound up heading in another direction. I think, rethinking things can include software tools, certainly, artificial intelligence, machine learning, as well as outsourcing relationships. I think it's how you go about it with the outsourcing relationships. I mean, all I can speak of is our experience at Key. And, we've found a lot of success outsourcing because we looked upon that relationship as bringing people into the fold as team members as opposed to a strict vendor relationship. And so you have to fully integrate the offshore partners, and you're not just outsourcing tasks. You're all part of one culture. You all kind of know what the final goal is. And so when you use newer technologies, software tools, it can be very beneficial. I do, however, want to say that, with some of the complex deals, complex legal documents, definitions, some things just aren't going to be automatable, and they're just going to need a human to look at the data and do the analysis. And the more that your offshore partners are in lockstep with you and how you look at how your institution looks at things, the decisions you make, the better it works for both parties. I also think it's important that the offshore partner be credible, because that's if you know what you're getting back is a quality product, then it just pushes everybody ahead, that much quicker and more efficient. I would say that there are also time zone advantages. We don't just outsource tasks. Sometimes we have ad hoc projects that need a quick turnaround, and with the time zone advantages, it works out very, very nicely for us. I think also by integrating into the culture, I mean, with our offshore partners, we hold periodic town halls and we field questions from the analysts and see what their concerns are and try and make them feel a part of the team as best we can. And that's been very beneficial to us.
Thank you.
The other perspective that I have on that, in terms of, for example, how we at City National Bank have utilized Acuity, is that we look at the work that they do as really enhancing the job function of the analysts that receive the product. And what I mean by that is, for example, the financial statement spreading that Acuity does for our organization. That's a job function that if when we hire a very junior banker, say out of college, who their first job might be learning how to spread financial statements, if they're really good, they're only going to be in that job family for a short period of time. So, the expertise and the speed and the accuracy that we get from Acuity, then that junior banker can focus building his skills around, the interpretation of what those financial statement spreads mean. And it enhances the overall, I think, job satisfaction, as we found in that particular job family. So, I think that when we think of outsourced partners, we think how, not only to the speed, the accuracy, et cetera, but also how are they enhancing the job satisfaction of the recipient of their product.
Thank you, Michael, and thank you, Tom. And one thing I'd just like to say that financial spreading is a fundamental of the credit analysis. Accuracy is extremely important. and consistency is extremely important as well. So we are very glad to be partners of change for your banks and be a part of that journey. So talking about change, I would now like to ask David Martins. David, how do you see credit risk management evolving in the next 3 years, specifically in terms of underwriting and risk monitoring?
Yeah, thanks. I was going to echo the comments about working with you guys at Acuity, but then it sounds like it's an advertisement, so I'm not going to do that. But if I were going to do that, I'd echo those thoughts about the flexibility, especially with special projects that pop up, and it just gives it to us. It gives an extra flexibility. I guess the best way to do it. It's a very reliable source. So anyway, moving along. Yeah, over the next 3 to 5 years, I think I think there's 3 or 4 things that I see that are going on. And the first one is much more of a longer term trend, which I think will continue, which is the shift of limit monitoring, of real risk management to the first line from the second line. And I say that because if you go back to the 80s and 90s, you generally had that second line, the risk managers were dictated almost everything, and the first line ran around and complained about them, right? So that was kind of the dynamic that happened. And over time, it really has shifted to a point where it's much more mutual, much more of a discussion about where the business wants to go, where we think the risk management comes in. And what I've seen is now we have in the first line, we have a lot more risk management responsibilities in terms of understanding exactly what we're doing and why, so that the second line becomes a check on what we do as opposed to dictating everything we do. And I say I think it's been a long-term trend, and I see that continuing. So I think also too, the first line can be a little bit more flexible in terms of systems. We've been talking about systems a lot. A lot of the stuff that the second line of defense uses to report and things are those baseline systems that are more difficult to change, where the first line can add some technology to be able to move quickly. So I think that's the first sort of, we'll call it a mega shift, because it's not something that's going to change tomorrow, but it's something that I see happening more and more. I think the second thing that I see changing, and this really is as a result of what we've been through over the last, say 2.5 years, is the need to be able to model the portfolio more quickly. So if I go back, a few 3-4 years ago, it was fairly stable economic time after the financial crisis. And so we were modeling portfolio, we were modeling scenarios and things, but it was a fairly benign environment. And we probably got a little complacent in terms of being able to change inputs to overall strategic stress tests and things like that. We did them over time, maybe it was once a year, twice a year. And what we found over the last 2 or 3 years is, especially the last 12 months, we've had to model very different stress tests and scenarios with the portfolio because of the fairly rapidly changing view on the macroeconomic situation. You go back a year ago, I don't think too many people were talking about inflation, or they may have said inflation is a small transitory issue. And now I think everyone believes we just have embedded inflation. So, that's a huge change, especially since we really haven't had too much inflation in the last 20, 30 years. And a lot of the practitioners haven't seen it before. I am old enough, I've seen it before, but a lot of the middle manager people have not. And so that's going to result in us being able to drive, faster changes in modeling and all that for the overall portfolio, and be able to figure out where we think the stress may be coming from. As anyone would know, you look at the economists now and they're kind of frustrated because there are all these different scenarios, and they, obviously somebody's going to be right, but it's difficult to predict. And so because of that, we have to keep modeling different things. I think the last big change, and this is acute, is the whole climate discussion. And there's several pieces of that. I think being a French bank, it probably been more of a focus for Natixis over the last 5 years than it hasn't for many others. And so at Natixis, we actually have a temperature gauge in our portfolio. And every time we add something to it, it either increases that temperature, i.e. it's a negative, or it reduces that temperature. And we actually have targets based on that temperature. And that temperature is driven by fairly complex system where we use outsourced vendors to give us information on clients, et cetera. We match that up with what kind of facilities there are. So it's fairly involved because it's been developed over 4 or 5 years. So we actually have a temperature gauge on our portfolio. The second half of that is that we have ratings on each new facility, and that internal capital charge gets higher if that facility is considered more brown. So we have like a brown, a light brown, average, then we have like a green. And so there's 6 different colors in there. I'm not going to go all into it, but we have 6 different covers, but there's actually an internal charge. So it's more expensive to do a deal that's considered brown. And so I think the Texas may be a little bit more ahead of things than a lot of other banks, but I do think banks are going to have to adopt an approach like that. And so that's sort of the that's the third change, but it has 2 parts. So that's one part. The other part, and we've heard this from some of the regulators, is climate risk. And I think there's 2 types of climate risk. One is physical, and most people would say, well, we really don't worry about physical climate risk. Obviously, the heating of the climate is happening over a long period of time, flooding, wildfires, all that stuff. All that stuff should be included in our normal, day-to-day risk management to begin with. So that's really nothing new. What is new, though, is the social aspect of climate change, and reputational risk is heightened because of the awareness of climate in the social field. And so how do we work that into our assessment of risk? Are there some certain companies that are more exposed to that or less? And how do we measure that? How do we develop that? And we've had some inquiries from the regulators that seems like that's something that they want us to look more carefully at. So those are the things we see changing right now. But I think the economy is the biggest one.
Absolutely. Can't agree more, David. And very interesting perspective, I would say. And talking about credit models, as you said, they need to appropriately absorb the economic volatility. And as the responsibility of the first line of defense shifts to front office team, it becomes imperative, to have strong credit risk governance working through the credit cycle so that you can effectively manage your portfolio risk. And again, as you said, ESG, it is gaining a lot of traction, and its appropriate monitoring framework needs to be put in place now to be better prepared for future.
And let's be fair, that's very difficult to measure. We have created our own penalty system for this, but it's not like you can't look to the market to price it. You come up with it. And as I said, the French, the French shareholders really want us to focus on this, so we are. And so we create these things, but it's a very difficult thing to start. And as I think Robert mentioned, really change people's minds about how we look at it. So.
Yeah, but yeah, I mean, there is growing awareness, which is definitely bringing more attention to this. This brings me actually to a very pertinent theme in the current times, which is, what is the impact of change on the workforce, which is the engine running the banks, the front office teams, the credit risk teams, the credit admin teams. There is employee attrition everywhere. So maybe I ask Michael here. Michael, how are credit institutions affected by the Great Resignation, and how is this actually reshaping your talent strategy, the millennials?
Sure. Yeah, well, look, I think all of our institutions are impacted by the war for talent out there, whether it's, the Great Resignation or the fact that, over the last couple of years, employees have, migrated and working from home. I mean, there are all sorts of issues, but, from my perspective, since we compete, with all industries for talent, one of the couple of the things that we're thinking about and working on is, number one, making sure that we share with potential new employees just the fact that banks, are much more diverse oftentimes than they may perceive us to be, in terms of, we're technology companies as well. We're very diverse in terms of the career path that we can share for them. We're also, trying to address the fact that in many cases that banks are, they're not only technology companies, but, there's a lot of innovation occurring, not only in all of our institutions that we're talking about in, meetings such as this. we're also spending a lot of time rethinking the training that we do for, for all of our colleagues and giving them, a more articulated career path in banking. So gone are the days of just the annual review. I mean, we're doing quarterly check-ins and, and the like. We're dealing with, employees who might like to work remotely or in a hybrid environment. Obviously, we're revisiting, our performance and pay structures. So, I would tell you with all of these issues, we're also, focused on becoming a more diverse organization. So diversity, equity, inclusion is very important. Just yesterday, for example, we had the second annual meeting where we're doing, mentor and protege meetings. So like I will be a mentor to an individual in a different part of the business line, so they get access to senior management. So we're doing a lot of things to just up the engagement with a view that we want our employees to, better understand the culture of the organization, better feel a stronger connection to senior management, and let them know that we're focused on trying to enhance their careers consistent with their long-term career aspects and desires.
And Michael, if I could just make a comment there too. One of the,
Sure.
And you mentioned the whole hybrid work environment that we're all facing, and to a large extent, I think it's benefited our organizations because we can recruit talent from more than just our footprint. Of course, we can be recruited from as well, but part of the problem with just working from home is that a whole engagement piece, right? And how do you get people to stay engaged or be engaged with the organization? And as you said, carry a culture of an organization. And, for us who have been doing this for a while, we'll be fine. But for young people just starting out, it's a problem. And how do they build careers if they don't actually get to know somebody in person? So we'll see. That could be an issue for our industry down the road.
We spend a lot of time talking about that issue in particular, and just as we did our return to office event, so we more formally had a return to office mandate just in the last couple of weeks, and we're trying to do a lot of things to make sure that our colleagues redevelop that muscle memory of coming back to the office, but understanding that they're probably not going to be in the office more than 2 or 3 days a week anyway. So I think that, we're all challenged in that regard to find ways and mechanisms to just continue to enforce our culture, build engagement, and, make sure our colleagues feel that connection, whether they're working physically or remotely.
Absolutely. And what I feel is that pandemic has at least helped in removing the close boundaries. The virtual way of working has created more acceptability to global teams. But as you said, Michael, it is important to continuously invest in people. And we at Acuity definitely believe in the famous thing that train people well enough so they can leave and treat them well enough so they don't want to. Right. So with this, I probably go to Robert Zeller again and would hear his perspective on the end customers. Bob, you and your teams are pretty close to the end customers. So how are your customer expectations changing, and how do you think the race towards the customer centricity will change lending 2025 and beyond?
Yeah, sure. So, I think organizations that win in the future, they're going to put the client sort of at the center of everything they do. And this means being more than just a product provider. Clients want information to help them navigate an ever-changing, more complex business environment. And banks need to be solution providers. And we need to provide our clients with customized product solutions and information to help them, navigate the different life cycles of their business. And a couple of things that are out there right now that I know that we're all working on is that I'll use as an example is the whole transition from LIBOR to SOFR. Right, we're all dealing with that, and our clients, though, they need to hear from us and how this transition is going to affect their business. They want their banks to lead them through the regulatory maze, to help them provide solutions that make sense for their business. Clients have questions, and how does SOFR work, or is BSBY a better option for me? And banks need to be trusted advisors to help answer those questions. And I think clients overall, they're gonna gravitate towards institutions that have knowledge and not just products. Another client expectation, and we've all faced this as well, is the speed at which things sort of come at us anymore. We all know that timelines are shrinking, and the industry needs to find ways to respond better and faster to stay ahead of our competition, and in particular from non-banks. Agent banks are giving us ever shorter periods of time to respond to requests. It's down to a week, sometimes only a couple of days, and sometimes for very complicated requests. And we just need to make that happen if we're going to stay competitive. I know in our middle market businesses, we're looking at ways to reduce the entire timeline from the transaction origination all the way through booking and funding. And we're trying to reduce those bottlenecks and taking a serious look at where things get caught up in the process. And that's going to help us in a couple of ways if we can do that. And it's going to let us respond to our clients faster. It's going to take deals off of the street faster, so we're less risk from competitors. But it also allows to book loans faster. And when you think about it, you start earning revenue faster once you do that. So tools like Salesforce and Encino, or treatment-based approach to underwriting, are going to help us do that and help us streamline those processes, so we can get more efficient in our commercial loan process.
Definitely, Robert. And I believe, Robert, successful transformation requires every institution to redesign their legacy processes, eliminate all the non-value added and redundant activities, so that ultimately the front office teams spend more time with customers, more time on client differentiating and risk differentiating activities. That could potentially also speed up the speed to market of our overall new proposals. So let me now go to David. David, how's the role of credit analyst changing as artificial intelligence gains traction, and most of the manual processes are automated in the coming years?
Yeah, I think just touching a little bit on that conversation, with my background with foreign banks and really sort of large complicated banks, all that IT stuff on a large scale is very difficult, because you've got plenty of different countries, you've got different regulations, you've got different cultural approaches to change. And so those large changes of legacy systems have always been far more complex, far more expensive than anyone thought, in my experience. And they've had names like Greenfield and meaning one system, and they take years and years and years, and usually cycle through many different IT projects and things like that. And they're just, they're very all-encompassing, but they need to be done if an organization is going to move forward. Okay, the role of the analyst. So as you can tell, I'm old school. So my first comment is, it doesn't change the role of the analyst at all. They still need to read the financial statements. They still need to understand cash flow. They need to understand the business. So from an individual credit point of view, it doesn't change the job, if you will. I think where we can help a lot with automation is the bigger drive to capture data. We're forcing analysts to fill more forms out during their normal process. And so that's where we can try to get bots and things like that to fill out those forms in a more efficient way. And again, those forms, that way they're checked and become a more digital process, but it tends to make some of the analyst work more tedious. So they tend to spend more time on that than they do on the real analysis. So automating those types of features that in turn lead to a better understanding of data, that's where I think we can help. And the systems I've seen that are the best are the ones that can be programmed almost manually and almost within the team. some of the junior people are pretty smart, and we can use off-the-shelf systems to, manipulate things like this without touching any data. We pick data, we put it in a form. That's a fairly easy way we can use IT to move that along without, going back to that horror of trying to change a legacy system. So those types of things really help. I think the other thing is what I'm concerned about, especially with and this touched on something we talked about earlier, is that we have analysts that really haven't, they've been working 10, 15 years, well, 10, 12, 13 years. So they're very experienced, but they've never really seen a recession. They've seen of course, the pandemic, but as I think we all experienced with the flood of money that came in, it certainly wasn't a normal recession where all the businesses have trouble and all that. The problems were fairly isolated. And I'm sorry, I don't know the default rates, but I guarantee you they were a whole lot less than a normal recession as money in the system came in. And so, the problem I have with the analysts now is that they really need to know, they really need to know their job so they can point out things early on. So I think that there's certainly a role for technology to assist, let's say, just the average analyst, but it doesn't in any way replace the role that he's been playing for the last 20 years. It does on the portfolio management side, as we talked earlier, in terms of running higher level models, but the role of the analyst to understand a company and understand risks, I don't think that's changed. But, because I've got gray hair, so you're going to get that answer from me.
That's a really interesting point of view. I would add one or two other things. I mean, traditionally, the credit analyst was, focused principally, if not exclusively, on credit, whereas in the world that we all operate in today, we also have to focus on operational risk, reputational risk, all different types of risks. And I do think as, that role continues to evolve, I don't know, maybe we'll continue to call them credit analysts or just analysts, but, we're all dealing with, all different types of risk. Wouldn't you agree, Dave?
Absolutely. And to your point, like my team is responsible for making sure things got booked correctly, making sure that money came in, making sure, yeah, and you're absolutely right. So you're 100% right. It's not just about understanding the cash flow, but you're right. They have to understand that, and they have to be able to pick out things that are not working in the system and raise them as an op risk, right? As we all know. And so you're right. Absolutely. So that has expanded. Completely agree with that comment. I think the other thing, I just was looking at my notes that I scribbled down, was one of the other ways I guess technology has helped, and I think you all have alluded to it in some way, shape, or form, is we have a system here called Credit Alert. I'm sure you all have other types of systems, but basically they feed off of all the public flow of information that might be available, and then they also take information that's been either auto spread or spread in person, and look for things that are happening, like an equity price going crazy or a CDS spread going crazy. So we call it a credit alert, but that is something that has actually helped, because instead of every analyst looking at every single account every day, combing the papers, we have sort of an alert system that of course generates far too many alerts, but that's okay. We'll deal with that. But that is a very interesting tool. I should have talked about that too. So.
No, thank you, David and Michael. And the emergence of alternative data, though it's an interesting concept, we think it's relevant for mostly thin file customers, and it will be some time before they gain traction across the book. But the life of the credit analyst is going to be good only if they get good standard quality data set. And AI/ML, it cannot work if the data is not standard or if things are done differently by different analysts across the bank. So automation needs investment, it needs standardization, and most importantly, it needs the domain expertise. So that brings me to my next question to Tom. Tom, what do you think is the role of strategic offshore partners will be as the transformation gains more momentum? You spoke about Acuity as one of your partners, but how do you see that role evolving over the next few years?
Yeah, I mean, I guess kind of going back to kind of the concept from earlier, kind of what will be and what should be, might be different things depending on the institution. If you're just looking to save money and looking at offshoring as a basically just, a vendor relationship, it may or may not work. And like we've seen historically, instances where it hasn't. But if you acknowledge the value proposition of a strong offshore partner, you can leverage it. You can certainly take advantage of it. And if they're well integrated into your institution and into your culture, I think you benefit immensely. Obviously an institution is going to still keep their decision-making functions onshore, but it's how strong is the analysis that's provided to those decision makers, and the stronger your offshore partner, the more efficient the process and the institution can run on the credit side. I mentioned the advantages of the time zones. That's very helpful. As Bob alluded, we're getting less and less time to make very critical decisions, and it's definitely helpful there. And then there's, back to the, Michael's point about talent, it's two talent pools that you can draw from, right? And if you have a good, stable team with your offshore partner, I mean, everyone's going to benefit. And you can scale it up and you can scale it down, as we know how cyclical our industry can be. So I think that those are definitely the benefits.
Thank you, Tom. And of course, it gives you more bandwidth to scale up your innovation and digitization initiatives because of the domain expertise. And, a successful innovation will always be an amalgamation of technology and domain expertise, I'm sure. So finally, organizations, I would say, will or can never be ready for future for 2025 or beyond unless they start changing now. That's what we've heard from our panelists today, structurally, technologically, or culturally. So, it is definitely, I'm sure it would have given everyone a perspective of how can you think about your transformation and change initiatives in the lending in the coming years. So again, reminding all the attendees to please submit your questions in the Q&A box at the bottom of the screen, and I will share it with the panelists. And with this, I'm really happy to introduce you to Dr. Paul Allapart, a Chief Product Officer. Paul has more than 25 years of experience in international capital markets on both research and trading sides. Previously, he was Chief Economist at Nomura International in Hong Kong, a regional financial economist at Lehman Brothers, and is also visiting professor at a top management institute in India. So over to you, Paul.
Thank you, Rajul. And on behalf of Acuity, let me at the outset itself thank the senior participants on this panel. So sincerely thank David, Michael, Bob, and Tom for sharing your time and your thoughts from your years of experience on this discussion. I'm sure everyone in the audience benefited a lot from this discussion. As a company, we are very proud of the market-leading practices in 7 business lines, which we shared earlier. Lending services is one of our fastest growing business lines. It has been a trusted transformation partner for more than 100 credit clients. We have 20 plus years of experience here with one of the largest pools of trained, experienced credit analysts. We have about 1,000 of them in our 5 delivery offices. We have over the years integrated relevant domain-centric technology with our team of credit and financial analysts. And above all, we've been a flexible and cost-effective provider of trained human capital. And I think over the last years in particular, after the swing towards automation and also some panic over automation, there is much greater appreciation of the central role that credible, expert human capital plays at the heart of all that we do in capital markets. And as a company, I think we have over 2 decades of experience supplying that reliably to more than 420 financial institutions in the US and in Europe. If there is any follow-up, any of you in the audience would like or more clarifications on what you heard, I would like to highlight our business development team. The seniors in our New York office, John Lucchesi, Managing Director, over 13 years with us. Pedro Armstrong, also in New York, Managing Director there, 13 years with Acuity. And on the West Coast, we have Chetan Majithia as a Senior Director with about 5 years with Acuity. So with that, I'll hand it back to Rajul, but thank you for your time, and we open the floor to any questions you may have.
Thank you so much, Paul. And we have a first question already, and that is for Robert Zeller. Robert, why do you think that auto spreading will not work for your organization? What software programs have you looked at for auto spreading, and how has Acuity helped you with auto spreading?
Yeah, so right now we use Moody's Credit Lens, and Quick Spread is the module. So we're, I admit we're sort of in the beginning stages, and it's just, the variability in the statements that you get. Again, the public companies, the ones that are very consistent, those seem to work just fine. But when you get, we have a large middle market and business banking practice as well, and you can imagine those statements are very different from each other, and the machine needs to learn those statements over a period of time, and I guess over a period of time it'll get better. But right now, when I look at the way we sometimes calculate EBITDA, right? The add backs aren't something that I think that the computer's ever going to pick up in a way where you can just say, okay, this is the answer, right? If somebody's going to have to look at that and say, well, this makes sense or it doesn't make sense. So we may get the initial spreads, but I still think in a lot of those, again, in our middle market business banking areas, I think a full automated solution, I'm still not convinced, but we'll see. I could be proven wrong. Hope I am.
Let me comment on that as well, because to Bob's point, in our commercial business, whether it's in the middle market or in our business banking areas, we do transactions. Sometimes we get audited statements, sometimes we get reviewed statements, sometimes we get compiled financial statements. Sometimes we do deals on the basis of guarantor reliant, on tax returns. So it's very complex. And, to Bob's point, I'm not sure that automation can pick up the nuances and the critical issues that are inherent in that complexity.
Yeah, and I would just throw out that with regards to covenants and EBITDA definitions, every single one is a negotiated document. And, to find two that are the same is rare.
Yeah.
And it may be possible on a client by client basis, as the machine learns, over a period of years that this is, this is how this statement is spread, and maybe it'll get better. But that changes from year to year, right? I mean, you negotiate a new credit agreement and there's different add backs or whatever, and all of a sudden you'll get back something that that may not make sense. So I don't know, jury's still out. We'll see.
I think, Robert, there's another follow-up question on how is Acuity helping you on auto spreading. So I'm sure we have our own solution also for auto spreading, but the way we help training the tools, we help in sort of adding, continuously testing the financial statements and then passing on the feedback and sort of helping the whatever tool your bank is using. That's what typically we do, when we sort of help in, because the variability from, if you look at a key bank kind of a portfolio, from private loan management to community bank and SBA lending, there's a lot of variability in the formats and in the kind of, the adjustments that we make. But maybe over to you, Robert, to ask if you want to just add to this question.
Yeah, and it's really just what you said, Rajul. You guys are working through all of those things with us, and it's a learning process for us and for you, and we'll just, again, I don't know, there's one more I can say until we learn more about what it can and can't do. But again, the variability is a big problem. we're putting effort behind it. But we'll, again, like I said before, I'm still not convinced 100% that we'll ever fully get there. So.
And because, Robert, the spreads are the basis of fundamentals of everything, like annual reviews or underwriting packages. So the data correctness and whether the methodology is followed or the particular adjustments or credit DNA is followed, somebody has to make sure of that. So ultimately, the output has to be good. That's what our analysts make sure, that there is absolute correctness of the data of the spreads, and then sort of look at correcting all that, what we get from the automation, which is like sometimes we spend up more time cleaning it than what benefits we get from automation.
Well, that's right. That's right.
Yeah. So I think we have one more question. Does the panel think that further automation of lending application will lead to a change in risk appetite? It is difficult to automate those transactions around the edges, that is the ones that don't always confirm or are more of a challenge. Will firms look to standardize as much as possible, leading to a change in appetite for the more stretching proposals? Thank you, John. I hope I conveyed your question very well. So over to the panelists.
So I'll start with that one. I think the, again, my experience and what I do here is that large wholesale thing, and we would experience a lot of the same issues that Robert and Michael have talked about, where you've got a variety, we've got a lot of project finance, and you've got a lot of things going on. And so I don't see automation changing our risk appetite. I see it, trying to maybe control costs. But I don't see a time, in the next, let's say 3 to 5 years, the time we're talking about, that any type of automation will change the risk appetite. So I'll throw that out there, and everyone can say I'm wrong.
I totally agree with that. I think that the automation per se isn't going to change the risk appetite. The economic environment, the extent to which, we all work within limits, and whether it's industry sectors or based upon risk ratings, et cetera. But I don't. It may help us get better in terms of assessing risk, but I don't know that it's going to change risk appetites per se.
Yeah, I would agree. The risk appetite is basically determined by, our constituency, be it the regulator, be it our shareholders. And right. I don't think any sort of technology solution is going to change that.
The one other thing that, and I think David brought this up earlier on in the conversation, that's really interesting as it relates to either risk appetite or risk acceptance, is the whole issue around ESG and the environment and sustainability and all of that. And I think that might have more of an impact than, say, technology at the end of the day, just given the world that we live in and the momentum and what we're seeing just around the world in that regard. I think that's probably more impactful.
I think that brings me to the end of such a fascinating conversation this evening. I would sincerely like to thank our panelists, David Martins, Robert Zeller, Michael Walker, and Tom Crandall, for your valuable experience sharing and for your insights. Thank you so much, Paul. Thank you to all the attendees for joining us across time zones. Hope you have a wonderful rest of the day. Namaste.
Thank you.
Thank you.
Thank you.